Ladies and gentlemen, welcome back to your January 17th stock market update. President-elect Trump, soon to be President Trump, on Monday just had a phone meeting with President Xi of China. And some of those headlines coming out are boosting equities today. And I think we're going to see a further boost to equities when we not sell the news, but buy the news coming on January 20th. Usually it's buy the rumor, sell the news. We have been selling the rumor of Trump's bad policies. We're probably going to buy the news coming on Monday. I will explain that here in this video. I will give you all of the major headlines, what's moving our markets, and why I'm bullish. But just first, take a look at this trend line. We have 1, 2, 3, 4, 5, 6, 7, 8 touches of this trend line on the S&P, on the SPY. It has been very well respected recently. What happened today? You gapped up above that. You are now in a clean breakout, and I don't really see the negative catalyst to stop this. Again, just to get back to a neutral place on markets, you're going to have to see a pretty nice rally. And that is my expectation. And I will break all of this down throughout this video. Ladies and gentlemen, hit the like button and subscribe to the channel if you are invested in our markets. Let me know if you are bearish, bullish, or neutral down below in the comment section, and let's get started. Trump says he discussed TikTok with Xi. Completely separate note here. It looks like TikTok will be banned. Looks like the Supreme Court is upholding that, and they are not going to allow a delay period. You can see here, Supreme Court is upholding the TikTok ban. The app will be banned in the US on Sunday, if not sold by its parent company. Okay, now Trump says their call between Trump and Xi was a very good one for both China and the US. And China's Xi says essence of China-U.S. economic and trade relations is mutual benefit and a win-win. Confrontation and conflict should not be our choice. So I think the fact that China's president is really talking down the whole possibility of a trade war between the U.S. and China is seen as very good news today for Tesla, for the broader markets, obviously for Tesla, because Tesla does a lot of business in China. I don't think even in a trade war scenario, Tesla would necessarily be targeted or would be, barred from doing business in China or anything like that. But it's good for, everyone from the market's perspective, from people's inflation expectations. Right? Because without a trade war, we don't have aggressive tariffs on either side that would impact inflation. Because, Trump putting tariffs on China is one thing, but China retaliating and putting tariffs on the US, that's another completely different thing. And that could be a big problem. And it looks like we're getting further from that, not closer to that today. And that's really what I think is the biggest driver of markets today. China's President Xi said in a phone call with Trump, quote, "We both place great importance on our interactions and hope for a positive start to China-U.S. relations during a new U.S. presidential term." That sounds really good. Not even going to lie. That does not sound like we're walking into a trade war. That doesn't even sound like we're going to see broad-based tariffs. That sounds like maybe certain industries are going to, have some tariffs put on them, but not, a broad-based kind of huge tariff. Bank of America's Hartnett says Trump trade to shield U.S. stocks from a plunge, which that's basically what I've been saying for a while now, that the last thing Trump wants is for the stock market to do bad. The last thing he wants is to be the guy that came in and ruined the bull market. So I'm not super concerned about bad policies, about policies that are going to, hurt the stock market. And I think Wall Street's gotten way too convinced that bad Trump policies are coming. and that's not a reality. You can also see the market on open imbalance. The S&P 500 positive 1.5 billion, Nasdaq 100 385 million, Dow 30 up 300 million, and the Mag 7 up 195 million. So right to start off the day today, there was some pretty positive inflows. And the two leaders, Trump and President Xi, agreed to establish strategic channels of communication and maintain regular contact on major issues of common interest to the two countries. December industrial production month over month came in at positive 0.9% month over month versus estimates of 0.3% month over month and 0.2% prior. Factory production up 0.6% versus 0.4% prior. Mining up 1.8% versus negative 0.5% prior. And utilities up 2.1% versus negative 0.7% prior. So potentially manufacturing starting to get a little bit better. Manufacturing is only 20% of the economy, so that's not like super important. Manufacturing's been in a recession for a long time. But if manufacturing does come back, it's going to mean a more even potential economy. Instead of it just being in services, maybe manufacturing comes back a bit. That would be positive. Also being reported today that Scott Bessent, among many others on Trump's kind of economic advisory team, believes that targeted tariffs instead of broad-based tariffs will do more in bringing back manufacturing and companies into the U.S., also known as onshoring. So that is something that markets, I think, are reacting positively to today, that we're probably not going to get broad-based tariffs the way that we thought we would before, and that is likely boosting our markets. The S&P is up 1.2% at the time of recording this video. It is also being reported today that many, including Scott Bessent, he is likely to be confirmed as the new Treasury Secretary under the Trump presidency, that him and many others want to do or are advising Trump to do a many month kind of step up in tariffs instead of just one 20%, 10% tariff, whatever the number is on day one, to start with a 2% tariff. And then next month, do another 2% tariff. And then another 2% tariff the next month. And that should be a lot less inflationary, potentially, than just doing it all at once, I think is kind of how Wall Street is taking this. You can see today the VIX is down about 3.5%, down to 16.03, which is still on the elevated side. So there's still a little bit of nervousness within the VIX and within the markets. The Russell 2000 is up 0.5%. Nasdaq is up 1.76%. S&P is up 1.22%, and the Dow is up about 1% today. Bond yields are mainly flat today, falling a little bit, like a tiny bit, down to 4.605%. So we've definitely got some progress recently on 10-year Treasury yields, but I think we're going to see a lot more of that progress when we get into next week. Because at this point, as I said in the last video, we're setting up for a buy the news kind of situation. We've gotten so negative about Trump's policies, projected policies, and what's going to happen, that we've kind of lost sight of the positives in our markets. And I think after January 20th, which is on Monday, you're probably going to see an aggressive rally to the upside as Wall Street buys the news on that, as they say, oh yeah, it's not as bad as we thought. The bull market is alive and well. I mean, that's just not what has been happening recently. Markets have grown extremely negative. Even today, following the last couple of days, markets have kind of recovered. You're still pretty damn negative. CNN's Fear and Greed Index is sitting at 38 today, which is a far cry from being bullish. You're still in fear, almost midway through fear. So, I mean, that's not bullish the last time I checked. Percent of stocks trading above their 50-day moving average at 41.22%, meaning that 59% of stocks are still in an active decline. I mean, that's a lot better than where we were at the lowest point. About 20% of stocks were trading above their 50-day moving average. But you know, it's a far cry from being bullish at the same time. So definitely some more room there to recover. And only 25% of investors believe stocks will be higher 6 months from now, versus 34% that are neutral and 40.6% which are bearish, which is the highest level of bears you have seen in at least the past year, in which in the past year we've had a 7% correction and a 10% correction. But yet people are more fearful now as Trump heads into office than they were at any one of those other corrections within the last 12 months. That doesn't make a whole lot of sense to me. On Farrell, he works with digital assets over at Fundstrat. He says cool CPI, soft retail sales, a sharp Besant hearing, not a lot of macro data next week with significant upside headline risk. The math checks out. So basically, he's saying you're probably going to rally next week. Says the Supreme Court's decision on TikTok was expected and everyone must respect it. Trump says my decision on TikTok will be made in the not too distant future. Tom Lee says today that market internals show signs of bottoming, with the percentage of S&P 500 stocks above the 50-day moving average falling to 16%, the lowest since November of 2023. Sentiment indicators such as the AAII percent net bulls falling to negative 15%, the data that I just showed you, suggest nearing capitulation, though not complete. January barometers are positive so far, with the first 5 days being positive, 82% probability of full year gain, and January month to date up 1.2%. And since everyone now hates, or seems to hate, Tom Lee, take a listen to what Fundstrat's Mark Newton says about our markets. He is the chief technical strategist over at Fundstrat. He says long-term market trends remain in very good shape.
About the stock market and the broader markets, major indices coming off their best day since the day after the election. Stocks jumped following a cooler than expected inflation data. Join us now, Mark Newton, Fundstrat Global Head of Technical Strategy. And you're fairly constructive, I think, Mark, but your one concern is breadth. And we talked earlier with someone about perhaps interest rates either staying where they are or at least not coming down, which is not great for the small cap. So I don't think there's no relief in sight for you.
Yeah, thank you, Joe. Happy New Year. Breadth did get hit very hard starting last fall. We saw declines in healthcare. Just in the last month, we saw really 7 sectors lost more than 4%. So, the percentage of stocks right now above their 50-day moving average is down to about 25%. So it has been a very hard-hit market in the last month. The one saving grace is that technology, to its credit, came back and actually has helped the broader indices remain afloat. So long-term trends actually remain in very good shape. It's more just near-term breadth deterioration, as well as I think sentiment has also gotten abnormally, pessimistic regarding the potential plans for, the president-elect's policies, which many of those we don't even really understand the extent to which that could be inflationary, and there's a lot of forces that go against that.
Happens, yeah, what becomes law or is actually done. But it still seems like you're saying, look, the indices are holding up, even though if you lift up the hood, what's going on is not great when you look at the detail. You still like 6650 for the S&P, though?
Well, it's just January. That's my year-end target. I do think that's going to be hit. Interest rates have gone up for reasons I think that many don't understand. Some of those have to do with longer-term Treasury supply and the incoming Treasury Secretary's plans on potentially funding some of this debt in longer treasuries.
Yeah.
So these things aren't necessarily, we saw yesterday by the CPI data, that wasn't necessarily inflationary. I think that's in the rearview mirror for the Fed, honestly. So the reasons why Treasury yields have been spiking don't necessarily have anything to do with what the common narrative is. My view is that rates are going to start to roll over in the months to come. That should be bullish, just given the recent correlation. Treasuries and equities have been moving almost in unison, and so I think that is going to continue for the time being. All equity, investors need to be concentrating on what's going on with yields, more so the velocity of yields. If they were to spike above 5%, that would be a short-term concern for the market, but we haven't seen, substantial trend damage to think that any of our upside targets that we set last month are going to be derailed.
We've had other guests on just today that almost said things that were in direct opposition to what you just said, expecting inflation either to stay sticky where it is or even move higher, potentially, and for interest rates to at least stay where they are, possibly move higher. You think the corollary, or you think the other situation happens?
I think things are a little bit overbaked with regards to yields having pressed up.
And inflation, too. You think inflation is under, you said that it's in the rearview mirror for the Fed?
I think that's absolutely correct.
Really?
When you look at the factors that make up, inflation with regards to shelter,
then he
car
mentioned
prices
shelter being the sticky
What about
point.
energy?
Yeah, $80 oil.
Look, I think the incoming administration's plans are to ramp up production by at least over 3 million barrels a day. That's going to be something that's going to cause crude oil likely to fall down to 50, potentially 40. That's my target. So I'm actually underweight energy for the year. I don't think that's going to be a big deal. That's going to cause further disinflationary pressure. And I think China is something that nobody's talking about. I mean, they're entering a time when it could be a very deflationary time, not unlike Japan was in the 90s. Their interest rates are down 300 basis points below Treasury yields. So that's something that they're going to need a lot of stimulus to be able to help their economy recover. Those are factors that are going to offset any potential tariffs being inflationary, in my view.
I think me and Mark Newton there see eye to eye on a lot of different things. The fact that inflation is probably an issue of the past, that we're probably done with the inflationary problems that we have seen, and markets have just gotten way too negative. They've gotten way too convinced that we're going to see higher and higher inflation, that the Fed's not going to be able to cut rates. Fed Williams came out yesterday and said 3 to 4 rate cuts could happen this year if the data participates. And I think the data will participate. In fact, I think we're going to have a strong economy with low inflation. Not even necessarily a soft landing, a no landing with low inflation. I don't even know what the terminology for that is. People haven't even talked about that, because technically a no landing would be like higher inflation and no economic disaster. I don't think we're going to see the high inflation part. Now, with that said, I think short term we are setting up for a pretty aggressive rally, not a small rally, a pretty aggressive rally here. Okay, take a look at the S&P. Look at this trend line that I've had drawn on the chart. You have 1, 2, 3, 4, 5, 6, 7, 8 touches. We're back above that. We gapped above that today. I don't know any better technical indicator to suggest that we're about to rally than that. I mean, it's Friday. On Monday, you have Trump's inauguration. You're going to see a buy the news situation there because sentiment is so negative. Just to get back to something that is kind of neutral, unlike the AI Investor Sentiment Survey or CNN's Fear and Greed Index, or to get a majority of stocks in an uptrend again, it's going to take a large rally. It's not going to be a day or two. It's going to be a couple days, maybe a couple weeks of a rally for markets. And in the underlying backdrop of our markets, earnings so far have been good. Banks have been good. TSMC was good. There's no reason to expect earnings are not going to be good. And I think earnings, broadly speaking, are going to impress throughout the next couple of weeks. So mix that together, markets being very negative. It looks like tariffs are not going to be nearly as bad as we thought, not going to be as inflationary as we thought. The economy's doing good. CPI came in low. As Sean Farrell said on X, I mean, we're set up very well heading into next week. And I think the earnings will continue to support that. So considering we've seen some incredible damage under the surface to our markets, it is time that we get some of that back. And I think the people that have been buying the dip in the last couple of weeks are going to be rewarded for that. From a technical perspective, it definitely looks like it. This looks like one of the cleanest breakouts we've seen on the S&P in a while. Okay, we just straight up gapped up above this trend line. I don't think that should be ignored at all, because this is a pretty solid trend line. You got what? Again, 1, 2, 3, 4, 5, 6, 7, 8 touches here. and other instances that were pretty close, it seems like this trend line was being respected a lot by markets. So let me know what you guys think about this down below in the comment section. All of this information, I'm open to opinions. I think anyone's opinion is valuable right now since nothing is, set in stone. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.